What it do, fam? I want to take a bit of time to go back in time to review what we mentioned about one of the hottest and most volatile stocks so far this year. I want to use it as a learning experience for when approaching new investments in the future. Specifically, what we're talking about today is HMM, whose stock did a bit of flying after its earnings report was released on the 24th, with an increase of 20% in one day, jumping from 28,450 on the 23rd to 34,150 on Friday, March 26th, before dropping back to around 28 flat by market close at the end of last week. You're watching Sekkider, and this is HMM, the story thus far. Now, before we continue, we want to remind you that this channel is meant for educational purposes only and isn't meant to replace legal or financial advice from a paid professional. And even episodes like this that mention stocks specifically aren't meant to be an endorsement for said stock. Only you can decide what's right for you, and even episodes like this are not meant to be a way of swaying your opinion. We all have different goals, plans, and strategies, and what's right for me may not be right for you. As always, we implore you to do your own research before spending any money on any stock. That being said, if you like the content that we're putting out there, please do us a favor, like and subscribe. But we got a lot to talk about today, so let's just get to that real quick. Alright, before getting into where we are, let's go back to November to our first episode of what we're watching and see what points we made about Korea's largest marine trade organization. Shipping. Alright, so this week saw a big booty boon in the shipping industry with HMM continuing its tear up the charts. If you don't know, HMM, Hyundai Merchant Marine, is Korea's largest shipping company and has been drawing attention since its Q2 earnings showed a profit for the first time in 5 years. Yeah, you heard that right, 5 years. Since the announcement though, the stock has risen from roughly 5,200 won to just over 14 at the end of this week. Now, is the momentum just hype or fundamentals? I don't know, let's look at the bones right now. HMM received and activated their newest fleet of ships in the first half of this year. These ships, which can carry up to 23,000 20-foot container boxes, are some of the largest of their type in the world. And according to the Minister of Oceans and Fisheries this week, they're already packed to capacity. Korean exporters are having trouble getting spots on these ships even with the new injection of ships. On top of this, HMM is slated to receive 8 more medium-sized ships by mid-2021, further increasing their shipping capacity. The profits themselves probably won't be realized until the third quarter of next year at the earliest, but with the surplus of demand, it seems like they'll be able to fill them up upon arrival. Furthermore, their moat got a whole lot bigger back in 2017 when Hanjin Shipping declared bankruptcy. That allowed HMM to leapfrog them to the country's #1 shipping company, as well as 8th largest in the world. Finally, in August, they unveiled their new high-tech digital fleet control center, which allows for real-time monitoring of active vessels and their vitals. Another very important change, last year HMM joined a shipping community called the Alliance and became a regular member in April of this year. The Alliance is a group that consists of Hapag-Lloyd, Won, and Yangming, and with their inclusion in the Alliance, HMM seeks to cut down costs and inefficiencies within their operations. It's still early, but HMM could be a really good turnaround stock going forward. Plus, with such large overhead costs to get into the shipping industry as a company, it seems as if HMM has a sizable moat for the time being. Competitors in Korea include Pan Ocean, Daehanhaeun, and KSS Haeun, just to name a few. It may also be important to note that since these shipping companies have started gaining traction, shipbuilding company stocks have also seen a nice little bump. It may be worth your time to look into this a little bit more if you're interested. Now, a lot of what we mentioned remains true, particularly regarding things like new mid-sized vessel fleets going into operation, as well as the value of joining the Alliance, among other things. Using that latter example as a jumping off point though, I want to expand on a concept that was mentioned a couple times but I haven't really done any explaining on in the past. Specifically, today we're talking about moats. Actually, you know what, I think it's best that we go straight to the source since Warren Buffett is objectively a better authority than I on moats. So let's see what he has to say.
We try to, we try to follow Ben's principles in terms of the attitude we bring toward both investing and in buying businesses. But the most important thing what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle. And in essence, that's what business is all about. I mean, you may want to be the lord of the castle yourself, in which case you don't worry about that last factor. But what we're trying to find is a business that, for one reason or another, it can be because it's the low-cost producer in some area. It can be because it has a natural franchise, because of service capabilities. It could be because of its position in the consumer's mind. It can be because of a technological advantage. For any kind of reason at all, that it has this moat around it. And then what we have to decide is all moats are subject to attack in a capitalistic system. So everybody is going to try. If you've got a big castle in there, people are going to be trying to figure out how to get to it. And what we have to decide, and most moats aren't worth a damn in capitalism. I mean, that's the nature of it, and it's a constructive thing that that's the case. But we are trying to figure out why is that castle still standing, and what's going to keep it standing or cause it not to be standing 5, 10, 20 years from now. What are the key factors, and how permanent are they? How much do they depend on the genius of the lord in the castle? And then if we feel good about the moat, then we try to figure out whether the lord is going to try and take it all for himself, or whether he's likely to do something stupid with the proceeds, etc. But that's the way we look at businesses.
Alright, so the concept of a moat is, as was described, a form of protection that gives a business an edge over their competitors and protects it from any challenges to their dominance. As with real moats in real life, a business's moat should not only keep competitors away, but also expand over time and improve the quality of protection that it provides. Essentially, a good moat is one that provides a company a competitive advantage to other companies that other companies do not have. So let's take a look at HMM's moats that we previously addressed all the way back in November. 1. Prohibitive costs of competition domestically. Now, the channel Economics Explained has a really good video on the merchant marine industry, but to save you a good 15 minutes or to preview their video if you intend to check it out later, it's best just to say that the international shipping industry is simultaneously lucrative and capital intensive. Unlike retail clothing brands, gyms, restaurants, or even tech, where constant innovation is necessary, otherwise you risk losing customers to the hottest new thing, new competitors in the merchant marine industry aren't something you come across very often. To give you an actual idea of what this means, transportgeography.org suggests that the annual cost of owning, running, and servicing a Panamax freighter, one of the most popular models in the world, is about $9 million per year. While ship prices are difficult to nail down, the KSOE signed a contract in February to supply 5 mid-sized petroleum carriers for $230 million for an average of $46 million per ship. VLCCs, or very large crude carriers, can go for $120 a pop, whereas their mid-sized counterparts can go into the $60 million range. This is all to say that unlike in many other industries, it's not likely that you'll find a new young container shipping startup around the corner. Now, what really sets HMM apart in this matter is its previous absorption of the bankrupt Hanjin Shipping in 2016. Now, while not a monopoly in fact, HMM functions very much like one, with its size providing a massive moat that its other major domestic competitors likely have no chance of surmounting in the near future. Alright, 2. The international shipping industry is very good at protecting their own. Even before the pandemic led to massive boons in freighter rates, there were already complaints and accusations against container shippers for being oligopolistic or cartel-like in their price fixing. Let me read you a quote from Sea Intelligence Consulting CEO Lars Jensen in an article from July 2019. An oligopoly is an industry where the market is dominated by a small number of large sellers. What technically constitutes a small number is up for debate, but another aspect of such a market is that the number of sellers is low enough that each seller can develop strategies around the likely responses of other players in the market to any action that they themselves might perform. From a global perspective, the 10 largest liner shipping companies had a market share of 12% as we entered the new millennium. Today, that share has increased to 82%. On the deep-sea east-west trades, this is additionally concentrated into 3 alliances that control the vast majority of capacity. It's important to note that in the alliances, only capacity is coordinated, not commercial activities and pricing. However, this means that the design of the core ocean products, as well as managing the supply of the equation, is clearly controlled by just 3 groups. On the commercial side, this has been reduced to 9 main players, of which 2, HMM and Yangming, are substantially smaller than the top 7. Alright, now that last point about HMM and Yangming being smaller than the top 7 is still true, but as of 2 days ago, with its launch of the first of 8 brand new cargo vessels that we mentioned in our first video, HMM's shipping capacity is set to add another 50% of its current size by year end. In any case, even without the 3 main alliances, 2M, the Alliance, and Ocean, all caps, the 10 largest shipping companies in the world already control much of the shipping trade, and not much is likely going to change that in the short term. There's an informative post by ShipLily that I'll link to in the comment section below that discusses the benefits of shipping alliances, but the point is that not only is HMM's domestic moat deep and wide, but its international moat is also fairly secure. But wait, let's hold up a second. See, this is all fine and well, but how do we know if it's an overpay to buy the stock at its current price? Well, let's look at the numbers. Long before we made that video, when HMM first declared a turn to the black and it hopped up on our radar as a potential buy, it was sitting around only 5,001 per share. Let's take a quick look at a few straightforward things that we looked at that you can replicate yourselves when judging the buy low value of a turnaround company like this one. Using Reuters' free financial info page, we started by looking at their net income declarations in the years leading up to turning a profit. Now, as we can see, they were all net negative on the year, which we already knew. What we really wanted to look at was the trend, and it reads very simply. 2016 saw a loss of 484 billion won, followed by a much larger loss of 1,318 billion won from 2017. From that point on, HMM continued in the red with a total loss of 790.56 billion in 2018, 589.84 billion in 2019. And generally it looks bad, but what's really important to understand before even trying to explain these numbers is that the yearly changes between their net income statements was actually a positive one. Specifically, it's helpful to see the numerical trend year on year starting from their bottom point of 1.2 trillion won in losses in 2017. Between 2017 and 2018, HMM reduced their losses by a total of 427 billion won, or a little over 35%. Between 2018 and 2019, they cut their losses by another 200 billion won for a little over 25%. This was achieved in spite of a massive economic slowdown in equities in the latter half of 2018 that year. In spite of sustained losses, this comes to an average improvement of 30% year over year. Now, understanding the numbers provides more insight into what actually happened to make these numbers the way they are, and this can be done by reading yearly reports and news from that time, but here are the most poignant happenings that I can think of. In 2016, the company was directly affected by the worldwide shipping crisis that inevitably led to the downfall of Hanjin Shipping. This was due to a glut of shipping vessel supply combined with consecutive years of subpar trade growth in the recovery from the 2008 recession. The next year, 2017, HMM saw significant losses to their net income, mostly as a result of their acquisition costs for things like shipping terminals of Hanjin, 2 container vessels, 5 VLCCs, and 16,000 container boxes. When reviewing the financial statements from the end of that year, it was clear that these purchases were aimed at laying the groundwork for the growth that we saw up until this point. In 2018, the company continued to improve their fundamentals with an increase of 21.7% on revenue on the back of increasing freight rates and decreasing costs in cargo handling. And that's significant when considering that roughly 33% drop in sales revenue in their bulk business due to things like the US trade war with China. This was also partly due to savvy moves by management to focus more on high profit cargoes and vessel charter out strategies. Finally, although the reduction of transported volume continued to fall through 2018, they were still able to grow their revenues using the same strategies in 2019. A very significant inclusion in their 2019 yearly report was this little nugget that reads, "There is a chance to return to profitability after 2Q 2020 with our new cost-competitive ultra-large container ships." This was a prediction that proved true, aided by factors such as increased trade demand and the collapse of oil prices in April of last year. Ultimately, through savvy management, a timely acquisition of the distressed Hanjin Shipping Company, and a significant moat, HMM progressively shrank their operating margin to a point where profitability became inevitable. All of this info is available for free on their website, on Reuters, MarketWatch, and Google, and this is the type of research that we suggest you do for every stock that you plan on buying. Now, as with all other public companies, they also publish quarterly and yearly reports as per the KIFRS requirements, but now that we have all this information, what should we do with it? Well, when we first did our analysis of HMM in the summer of last year, all of the momentum factors pointed to continued growth at a massive discount at 5,001 per share. With factors such as their high-tech ship tracking center, their increased ownership in strategic ports, and their membership in the alliance improving profitability, we expected to see a continued reduction of their cost of operations, goods and services, aka COGS, which has been dropping by an average of 9% year over year since 2017. However, with the price up near around 600% from that point, the question becomes a little more difficult. See, from a trading standpoint, the volatility may be attractive since we've seen a number of peaks and valleys. However, we need to address the question of whether or not the stock has become overvalued, properly valued, or if it remains to be undervalued. This part is very subjective. If you can't already tell, we like the stock, and this is important for you to know because it'll be very difficult for us to be unbiased from this point on. Anyways, to address these things without getting too numerical, since I recognize this video has gone on quite long, let's answer a few key questions. 1. Do we think HMM's moat is sustainable? In short, yes. It's extremely unlikely that the domestic competitors like Pan Ocean or KSS will challenge HMM for industry dominance in the short term. Plus, with HMM's 5-year plan to reach 1 million TEU shipping capacity by 2022 completely on schedule, there's a good reason to expect HMM to expand its market share internationally. 2. Do we believe that HMM's moat is likely to expand over time? Again, it's a yes. We already know that they're in wait of 7 more mid-sized carriers between now and September, and this will significantly decrease their fixed costs and increase operating efficiency, continuing the pre-existing trend for another year. 3. Do we believe the stock is reasonably priced? This is the biggest question to worry about, given that the steep jumps in stock price can lead to steep drops in the company if the company is too greatly overvalued or unable to live up to what investors are paying for it. To address this, let's use a metric we haven't talked much about on this channel before, the forward PE ratio. Now, this ratio is calculated more like the standard PE ratio, except that you're swapping out the EPS denominator with a projected EPS denominator. That is to say, instead of measuring tangible earnings, we're measuring it based on estimated earnings growth, and therefore earnings growth per share. And then we use that to estimate the price of the per share value using the PE method. Now, different models will project different sales in the future, and if you don't feel comfortable making those projections yourself, it's always good to use those that are already out there in the world, and let's look at a couple that we already have. The first one is Reuters estimates, which have it sitting at a forward PE of 4.34, suggesting that the EPS will eventually reach 4,627 won per share. Naver is even more bullish, projecting earnings to reach 7,018 on a per share basis with a forward PE of 4 flat. In either case, both projections make the assumption that earnings will grow, new shares will not be issued, and the company remains undervalued at its current price point. Now, trusting their forward PEs and their expected earnings is a bit of a leap of faith, so you might want to try to do the calculations for yourself. But there is little reason to believe that the trends that have led them to their profitability, including reducing their COGS and increasing their sales, and that has spurred on a little run here with their profit reporting, will reverse in the short term. So, from our perspective, even at this price point, we still like the stock. Now, this is by far our longest video ever, so we're going to stop here, but before we do, there are a few things to think about when looking at the shipping industry. 1. There were significant external factors leading to the glut in global shipping and the increase of freight rates. This may come down once the world gets back to normal, and it's important to factor that into your decision making. 2. Hanjin crashed and burned due to a massive overcapacity in the shipping industry and failure to pay their debts. With the shipping industry once again booming, HMM will have to be prepared to deal with events such as this to ensure that it doesn't go the same way. For that reason, be sure to watch the company's free cash flow going forward. And 3. With continual decreasing demand for fossil fuels, the long-term outlook for crude carriers is not really great at the moment. Demand may return in the short term as the pandemic clears up, but this past year has kickstarted a massive move towards green energy, and although the US and much of the West is going all in on Elon Musk's EV vision, most of Asia and much of Europe isn't waiting around and instead is focusing on safe hydrogen-based energy generation methods. In either case, it's certainly going to affect profitability once you've got skin in the game, so you may want to keep track of that. Alright, that's it for me. Sorry for the lengthy John around this time, but I just thought it might be worth it to chime in on a stock that we've mentioned before and has been tearing up the charts as of late. We'll be back soon later this week because there is a little bit of news that we need to cover, but other than that, I hope this helped. And if it did, please feel free to share our videos around. Appreciate you being here once again. Take it easy.